Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is May 2020. I'm your host, Arusha Pierce, and returning back to the show is Joe Fahmy. He is the Managing Director of Zor Capital. Thanks for being here, Joe.
Thanks for having me, Arusha. It's great to see you.
On today's podcast, we are going to talk about the current market. We will talk about the disconnect between the economy and the stock market, and then we will end the episode with 3 current stocks. So let's get into the current market. And right now, the market is in an uptrend. We had a pullback last week, and that was a little bit scary, but it was expected with the way the market has been running for the last 6 weeks. But it's amazing. We're higher than last week, and we're actually near all-time highs. Joe, what are your thoughts on this market?
Yeah, overall, I mean, I've been bullish since those follow-through days in early April, both on the S&P and the Nasdaq, and I'm just trying to follow the trend and stick to what the institutions are doing. I've been saying this on my blog for 10 years, which is pay attention to what the big institutions are doing, get a chart book, pay attention to price and volume, and there's just very little distribution on the Nasdaq Composite. Even during that pullback that you referred to last week, we had one distribution day, but overall, the institutions continue to accumulate shares on the up days. On the down days which are expected in an uptrend. You're going to have a few down days. The volume's not too bad, and the leaders are acting well. So overall, why argue with it at this point?
Yeah, and I think, and we'll get more into this in the second segment too, but sometimes you just don't want to even think. You just want to do. You want to listen to the market and react and just kind of go with the flow and trust it, because it's pretty amazing. So here's the fall through day there. Yeah, and a lot of times when you have such a severe sell-off like we had, you're going to have a couple of fall through days that fail, and that was kind of the expectation, at least for me. But you don't want to necessarily assume they're going to 100% fail, because sometimes they don't, like this one, and it's done almost the impossible. It's done the V-shaped rally that everyone thought couldn't happen.
Yeah, I agree with you. I actually was thinking it was going to fail because we're below the 200-day. I have found follow-through days above the 50-day, above the 200-day, or at least when we get close to it, have been more effective. So I was with you on that camp. But what was interesting is 90% of what I use to judge the health of the market is the price action of the leaders. And when I ran through my screens and I just, a light bulb went off and I just said, wow, here's another one. Here's another one. Software, semis, all these different leadership groups, they just kept showing up as, near highs, at highs. And that was a very powerful signal that, the follow through day had a little bit higher probability of working.
Yeah, and that's really one of the huge lessons. If you haven't capitalized on this market, and this has been a great market. It doesn't get really that much better than this for stocks. But if you didn't capitalize on it, or if you completely missed it, really one of the things that you want to do is you want to really let those leading stocks slowly pull you in. And just like Joe was talking about, one stock will break out maybe on that follow through day, and then a few days later, another one might break out. And then a few days later, another one. And it's just going to slowly pull you in. And then before you know it, you're pretty invested in this market.
Yeah, that's a great point. I know one of the things William O'Neill talks about is if you do have a heavy cash position and you've been defensive during a correction, and then when you get the follow through day, one of the things he talks about is at least look at the new high list. Take 1 or 2 positions and get you, like you said, dip your toe in, maybe take 1 or 2 positions. And even if they're light, the theory behind that is if they work, at least you make some money. Gives you a little bit of confidence that the follow-through day is working. And as you said, more stocks will set up behind them. If they don't work, you have a light position, you stop yourself out, and at least the damage is minimal in case the follow-through day failed. But what happened was I had a pretty heavy cash position for my clients. I took some light positions. They started to work. We saw more accumulation come into the market, and then a whole bunch of stocks came through. And I think the lesson here is, when people talk about timing the market, I kind of hate that expression because it makes you think like you have to get the dead low and the dead high. We're just trying to get the bulk of the move, because it's okay if you miss the snapback, but from April 6th into the middle of April, like you said, until up until now, it's been incredibly strong with all the stocks that continue to set up.
Yeah, and a lot of times that first purchase is the hardest purchase, and it could be even the smallest purchase. But even if you missed out on the downtrend, and it was a brutal downtrend over a few weeks, even if you completely missed out on it, like a lot of us did, it's incredibly scary to get back into the market. And so we'll use that follow through day, and we had it on the Nasdaq on April 6th. We had it on the S&P 500 on April 2nd.
Yep.
uh, we'll use those signals, and we'll put a little bit of money at least to work if in a stock that we're seeing is working. And a part of that is just to get ourselves, our psychology back on the offensive, because we're all really scared. I mean, I know I was scared, and I'm always scared when you're coming out of a correction, trying to buy it, even though if I protected myself, it's just very hard to switch that mental focus back to, okay, let's put money back to risk. And so putting a small position or two and then getting the feedback from the market, that's incredibly important to switch your mindset and start getting the momentum working, so you get more confidence to buy more stocks later on.
Yeah, that's such a great point because it's great what you said. Even if you missed a lot of the damage, when you get the follow through day, the mindset has to at least start to shift.
Right.
You have to at least start to think, if you've been shorting or if you've been in cash, at least put some money to work. And it usually is at scary times, but that's why there are rules. And when you get the follow through day and you get some decent basis to buy off if you put some money to work. Now, the mindset is tough because this is where recency bias affects us, where things have just getting so killed. You don't want to put money to work, but this is where you have to remember market cycles. Like Peter Lynch has said, I don't know, in the last 100 years, 30 something, 40 something bull markets, bear markets, whatever the numbers are. In history, you just have to accept cycles. There's going to be corrections and accept that and get defensive. But don't think that this is going to go on forever, especially because everyone thinks 0809 was down 50%, so this has to be down 50%. And that's the part where you have to shift that mindset and say, you know what, we've gotten through every other correction throughout history, and this is where that mindset really has to shift.
Yeah, and when you learn to protect yourself during corrections, you will also learn to, or you need to learn, that corrections really are opportunities. It's not
Yeah.
necessarily you're buying during those corrections, but you're building your watch list, your of stocks that are resisting the downtrend, that are showing tremendous relative strength. And when the stocks get ready to go back up again, uh, now you have that watch list. You're getting back on the offensive, and a lot of times those first few stocks that are, or those first batch of stocks, I won't say few, those first batch of stocks that break out, those are the next leaders of the next bull market.
That's such a great point. The same things happen in every cycle. 08, 09, we came out of a brutal financial crisis, housing crisis, 18-month bear market. When the follow through days started to happen in March, the first two stocks that made new highs were Netflix and Green Mountain.
Yes.
Green Mountain went up, whatever, over 11, 1200%, eventually got bought out by, I think, a private equity firm. And then Netflix is still to this day making new highs. So that's your point, that it's such a great point with opportunity, because as we come out of these corrections, you really want to pay attention to relative strength. In other words, if the market just dropped 32% on the S&P in pretty much a month and 42 on the Russell, and you have a stock sitting near highs, I think it's pretty safe to say if the market didn't bring that down, then nothing's going to bring it down.
That's true.
So that's, I mean, the institutions, they might be dumping other shares, but they're not dumping the stocks that they really believe in longer term and understand the stories. And there you go. There's the Netflix high right around March, April of '09, and the rest is history. So
Yeah, I mean, let's see, that high around, or I'll move it over to like
split
I'll move to
adjusted.
March of 2009, high of $6.35. Right
It's
now, it's
amazing.
split adjusted, but now it's $447.
So
Now
that's
it's not. We're
that,
not saying that you ride through the whole thing, but there are tremendous opportunities for those that are right near new highs, and so the corrections truly are opportunities.
yeah.
Now,
Yeah.
oh, go ahead, Joe.
No, I was going to say that's a good point about everyone has different time frames. So I don't care if you day trade, swing trade for a few days, few weeks, few months, or a longer term holder. It doesn't matter what your time frame is. At least you are starting with a great stock to at least put a high probability of being, of success because of the technical characteristics.
Yeah, and then what's the worst going to happen, right? If it breaks out and fails, for the most part, it's going to be 7, 8%. You're cutting at some
Yeah.
kind of loss. Once in a while, maybe they gap down and you take a bigger hit. But for the most part, most of my losses are probably around 4 to 5%, and so that kind of gets away from that fear factor too.
Yeah. Yeah.
Now, Joe, now one thing that you mentioned on Twitter and also on your site is one of the concerns that you had recently with this rally, because it has been such a strong rally, and it's been in the back of my head, like, okay, when's that first big test coming? The sentiment indicators, right?
Yeah.
So some of the sentiment indicators on the what was the put call ratios are starting to get to pretty much complacent levels.
Yeah, sentiment is such a hard thing to gauge because there's so many different measures and readings. So I try to look at all of them together. For the most part, up until recently, yes, there's a lot of people buying calls and so forth. But up until recently, a very powerful one is that AAII, where we've seen since 1987, it's happened 54 times that we've seen a 10% or greater rally in 7 weeks in the market, and this is the first time that this has happened, and the AAII has been over 50% bearish. So
Oh
that's
wow.
that's never happened in history. It's actually happened over 40% twice, and that was December of 90, which is when we were coming out of the Gulf War and the 90-91 bear market, and
Yeah.
then April of '09, where again the stat is 54 times since 1987, we've had a 10% or greater rally, which happened from March of '09 bottom to April of '09. And late April of '09, over 40% were still bearish. So this is unprecedented that it's over 50% bearish. So as an overall backdrop, of course, we're going to see some pullbacks and some shakeouts along the way. But that is a very powerful stat. Combine that with 5 trillion in money market funds,
Yeah.
which is a lot of public money. That just tells you how scared and underinvested people are.
Yeah, and so that's the proverbial wall of worry that the market loves to climb, and that's exactly what you're seeing here. I mean,
Yeah,
if you're, and we'll and maybe we'll say that for the second segment,
yeah,
but this is just a fascinating few months that we've seen, because it really is unprecedented for just throughout at least the last 100 years. Now we had the pandemic flu, but in the early 1900s, but just the way it fell apart, and there's still, we don't know for sure, how long it's going to take for a vaccine and all this stuff, for the
yeah.
market to just keep going up like this. It's just that wall of worry, and if you're letting news tell you what to do, you're going to be pretty frustrated.
Yeah, I to answer your question on the put to call ratio, I like to watch the equity only put to call ratio because the index tends to be a lot of hedging with people with big portfolios, but the equity only tends to be people buying directional puts. So along the way up, I've noticed recently there has been a lot of call buying. Maybe it's because everyone's at home and people are opening online brokerage accounts
Yeah.
and so forth. So that could be a shorter term signal for a little pullback. However, I've noticed that people buying calls can go on for a while, but when
Mhm.
they really spike into the puts, that's usually around a day or two of a low. So
Oh
that's
yeah,
another.
and that makes sense, because everyone gets scared essentially near the same time when you
Yes.
start seeing everything falling apart.
You
Those
just have to
emotions.
wait for it. You just have to wait
Yes.
for it. For
Yes.
example,
So.
in October of 2018, we had that correction in the fall,
Mhm.
and there was put buying, but it really didn't spike until December 21st, 22nd, which was a day or two off of the low.
Right. Yeah, that's
Yeah.
absolutely
Like a
perfect.
high reading. So the higher readings on the put side are more effective than the call reading. But overall, I try to get a whole basket of them. CNN Fear Greed and Investors
Mhm.
Intelligence and NAIM, Active Investment Managers. And it's really muted. And that's the whole point is we've had this great rally and people are still scared. So my feeling is you're going to get pullbacks. I just can't see something really sustained when everyone is hedged and prepared for it.
True. So the market is in an uptrend, and we potentially could be starting a new bull market. Who knows? Maybe we're in it right now. It sure feels like we are in a new bull market, but make sure you remain disciplined because a lot of stocks are extended at this point. Let's take a quick break, but when we return, we are going to talk about the disconnect between the news, the economy, and this stock market, this V-shaped rally. And how can this market keep going up with all this bad news around? So we'll talk about this and even more. We'll be back. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Joe Fahmy is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Joe, there's so much bad news around. How can the NASDAQ be right near all-time highs?
Yeah, that's probably the number one question on everyone's mind. I get emails about it. I get everyone asking me, clients, everyone, this doesn't make sense. The economy's so bad. Why is the market recovering? And my first answer, as simple as it sounds, is when does the market ever make sense?
That's
true.
If
it was, it's not designed for it to be so easy and just hand money away. So understand that the market is a very challenging beast and it doesn't always make sense. But the real answer I think of is it's a discounting mechanism. And a lot of people fail to understand that the market trades on what's going to happen 6 to 9 months from now. And yes, it tends to rebound while unemployment's still high and while all the economic numbers are still high. Same thing happened in 08, 09. And it tends to forecast better things ahead. And I think the number one question people have to ask themselves who are confused is, are we eventually going to get out of this? And I think if you have any sort of sanity in your answer is going to be yes. I mean, like, we will eventually get out of this. Now, right. The second part of that question is, when do we get back to 70, 80% normal? Is it 3 to 6 months from now or a year or two from now or longer? That's the hard part that nobody knows the answer to, but it could be the market telling us that things will get back to somewhat normal 6 months from now or sooner than most people expect.
Yeah, and the beauty is that if you're following the action of the market, you're following the price and volume action, and you have a good set of rules to follow these trending markets, you don't need to worry about that stuff. I mean, you want to be aware of it, and you want to do reading on it so you know what's going on, but you don't need to necessarily try to figure it out. And that not one person's going to figure out the true answer to that. That's the beauty of the whole market. It's collecting everyone's buying and selling decisions. And right now, a lot of people apparently have placed some good bets on this market, this economy, this world pulling out of the pandemic that we're in right now.
Yeah, I mean, we've got through everything else, and wars and other pandemics and other viruses and economic crisis. The list is endless. Natural disasters. We've got through everything. So we're going to get through this. And as they say, it doesn't make sense to bet on the end of the world, because even if you're right, no one's around to pay you off. So
that's true. That's right. I never thought about it like that. But yeah. I mean, who are you going to really collect from at that point?
I know your puts will be great, but you'll be the only one left.
So Joe,
go ahead.
Go ahead. Oh, well, Joe, let's get into one of the industries, one of the sectors that's been doing insanely well, and not shockingly, the biotech industry. Now, these are
Yeah.
stocks that have come up on your screens left and right, and you've talked about it on Twitter, you talked about it on your site, uh, and these are stocks that you're focusing on right now. Now, for me personally, I've always had a bias against biotechs because I'm a little scared that they're going to just gap down on me because of some FDA
Yeah.
news and things like that. But that's a weakness of mine, and that's something that, after watching some of your videos and things like that, I'm trying to I'm trying to correct that weakness. Talk what's going on about in the biotech industry.
Well, to finish that last segment, because it ties into biotech, besides the market being a discounting mechanism, if you didn't know the news and just looked at charts, you'd probably be loaded up in the markets right now, or at least you have been for the
Yes.
last month.
Yep.
And the reason is because the big institutions control the markets. Besides the follow-through days, when I talk about, I run my screens on MarketSmith. My go-to screen has 150 stocks on the first screen. 75 of them are biotech. Part of the reason I screen is to look for themes in leadership sectors. And when I see software, medical products, semiconductors, some FANG stocks doing well, and biotech, when there's 75% of my screens are biotech, I can't ignore that stat because I'm screening to find themes. Now, you pulled up the IBB. The first thing I'll say is that the IBB and the XBI are two of the main ETFs, and they are coming out of 5-year basis. And as we know, they had a huge run 2013 up until 15, 16. I think they corrected when that whole presidential election and, the tweets about drug pricing and so forth. But again, after huge moves this was an incredible leadership sector, huge move. You got to digest that gain. We have been digesting. And when I talked about after the follow-through day, some of the first stocks on my screens that were at new highs on April 6th were biotech stocks. So from a technical point of view, that looks great. My other theory with biotech is 6 of the top 10 performing hedge funds in the past decade are biotech-related funds. So you can't ignore the performance from there. The other thing is healthcare is 18% of GDP. So while all the younger generation is spending their time, on TikTok and becoming Instagram models, the older generation is spending their money on healthcare. And I can't think of anything why we would need biotech even more. We're all stuck at home. Everyone is shoveling food in their face and is going to get heart disease or diabetes. Everyone's drinking and going to have liver damage. All this is even more of a case for biotech. But on a serious note, as people are living longer, you are going to need, the spend on healthcare. But I just, to your point about being scared, it's a common thing. It's not scared, it's just worried about a 50% gap down. You have to differentiate between the small cap, one-hit wonders that might have one drug in their pipeline and the bigger pharma that have plenty of earnings and sales on the line. Your Vertex, Seattle Genetics, some of those stocks that made new highs on April 6th, the day of the follow-through day. Something like Vertex, this isn't a company with a phase 2 drug that's going to fail. This is a company with, 4 billion in sales, 5 billion in sales in the last year, and earning. The numbers are just insane. So I like to look at it as this way. If you're not comfortable with biotech, as always, do what works for you. There's nothing wrong with passing. I can't ignore it because there's so many stocks on my screens looking good. So you can go with the ETF, you can go with some of the bigger names, or you can just take a smaller position, because even if you took a 1% position in something, God forbid, like you said, gaps down 50%, if it hits you 50 basis points on your account, it's not going to ruin you.
Right.
And guess what? You actually might make money too if it goes up. So that's a possibility.
Yeah, and also, so you have this. Obviously, biotech is well positioned for what's going on with the world right now, but it almost seems like there's a convergence of a number of larger trends, all meeting together, and biotech is right in between. You have technology coming in, not only with devices for technology, where people can monitor their blood sugar and things like that. We've spoken about Dexcom and Insulet before. Those stocks have done really well. But you also have all this data starting to be collected They're using artificial intelligence to try to figure out
Yeah.
the cure or vaccine for the coronavirus. They're doing machine learning, artificial intelligence, and so it's pretty remarkable that you're seeing all of these things converge, and you could see an acceleration in a number of these industries.
I think the industry is just getting started. I mean, like something like gene therapy, when you have Roche and Novartis paying 5 to 9 billion on some takeover candidates, these are huge companies that spent a lot of money. So gene therapy is another one. You make a great point about technology is converging. Something like a GH, Garden Health, where they're
Yes.
taking a blood sample to, instead of taking a biopsy for cancer levels. And the people behind this company, like you said, it's not just PhDs in science, it's also in mathematics, big data, and semiconductors. They understand that now you can do a lot more with technology. So I think that this sector, I try to do everything I can in my power to help my probabilities of finding a strong couple of names in biotech. And that doesn't mean you're always going to get it right, but if you use the technicals as one, if you do have some fundamentals, that's great. If you dig into the story, if you follow some of the huge funds that have been incredibly successful, if you follow unusual option activity and just understand, to your point, that this is the future and biotech is really revolutionizing things and it's just coming out of a 5-year base. I think this is still in its early stages as to what's going to go on with not just viruses, but so many diseases.
Yeah. Now, before you brought up Garden Health here. Now, this is a potentially a huge story with what they're trying to do. So instead of taking a biopsy on tissue where you have to cut out a cancerous, what they think could be a cancerous cell or whatever, here you can take a blood sample and it's looking for like fragments of DNA that the cancer leaves. And so not only is it a lot less invasive, it's a lot less pricey for
Yes.
everybody, right? And so naturally, that could mean that a lot more people are willing to use it. And now you can move more towards the prevention because, as we know, the earlier you catch a lot of these cancers, the better chance of your survival. And so this, if they're able to pull something like this off, this is a huge story and a potentially huge idea because all of a sudden this could be just part of the annual exams or whatever.
Yeah, I think the founders started a company and sold to Illumina,
Mm.
started this one. Brilliant founders. And also, to your point about not only with the biopsy, but then a lot of chemotherapies are ineffective. So they're using big data and data analytics to make sure to
Yes.
pinpoint a lot of the chemotherapies to, make them effective. So again, I'm not a scientist. I'm just basically agreeing with you in the sense of the technologies that they are using, where it's a convergence of big data, artificial intelligence, machine learning, all those buzzwords in biotech. This is where I think, for me, I can't ignore when I see, again, 75 of the first 150 on my screens are biotech. I just have to get involved. And if you're not comfortable, then, a good way to play that. So you have to reduce single stock risk is with an ETF.
Yeah, well, Joe, years ago, you were smart enough not to be a bio major at Tufts University like I like I was, because that was not easy, and I don't remember any of it right now.
Yeah.
But it is pretty cool to see a lot of this stuff just getting more advanced and the precision medicine that's starting to come about, where you could have therapies just completely catered towards your body and what's going on in your body. I mean, that's kind of mind-boggling when you think about it, but that's maybe 10, 15, who knows, 20 years away from now.
Yeah.
Very, very personalized medicine. Maybe almost the same way as the web is right now, where all the content is catered towards what your interests, as opposed to 20 plus years ago when you just go to Yahoo or whatever and
Yeah.
you read whatever Yahoo thought was the news of the day at that point.
Yeah, and going back to your original question on the disconnect, when I'm seeing so many strong stocks and just a lot of great institutional accumulation, this is where I have to do my best to separate and shut off the news and pay more attention to price action because it's not just biotech, but there's just so many great sectors that are. I mean, look, bottom line is it's common sense. Unfortunately, there are industries and companies that are being affected by all this, and your
Hmm.
cruise ships and your airlines and restaurants, and we all know those sectors that are unfortunately getting hurt. And on the flip side, there are other sectors that business as usual, and in fact are even benefiting more, whether it's your software biotechs, and that's the sectors that I'm focusing on.
Yeah, and once again, the biggest thing, listening to the market. It's always gonna to lead you in the right direction. So remember, the market is always right. It does not matter how bad the news is. You want to follow the trends. When the market is saying to start putting some of that money to work, listen to it, put a little bit, and see what happens. And then, of course, you always want to manage your risk.
I
So
always
coming up
say,
next,
I was going
what's
to
that?
say, I always say two things I never argue with: the stock market and women, because they're both smarter than me and they're both always right. So don't forget that.
Coming up next, we will discuss a few more ideas with Joe. Stay tuned. I'm here with Scott St. Clair, and Scott is one of the senior product coaches at MarketSmith. Now, Scott, we've both been doing this for a long time, and we know that investment research takes a lot of time. There's so many factors that you want to look into to try to figure out whether this is a stock to buy or not. Quarterly earnings, huge sales growth. Hey, are institutions buying it? The list goes on and on.
Yeah, it's a common question. I hear it all the time. I don't have time to do this work. So you don't have to spend that much time. If you have a tool like MarketSmith, we do a lot of that work for you. Right there on the chart, earnings, sales, group strength, institutional sponsorship, like you just mentioned.
Right.
It's all there in the chart, so it allows you to make a decision much easier.
Yeah, and the beauty is that we have in-house analysts that go through the SEC filings. They pull out those numbers, and they put it right on the MarketSmith chart, and all you have to do is analyze them.
Yeah, I couldn't imagine having to go to the SEC website and look at the income statement, et cetera. That sounds like a lot of work.
Yeah, and that would take hours and hours, and in that time, you can go through hundreds of stocks and find the best ones. So don't miss out on a big winner because you don't have enough time to research it. For more information, go to investors.com/podcast2020. We are back with Joe Fahmy on Investing with IBD, sponsored by MarketSmith. Okay, Joe, let's get into a few ideas. And the first idea that we have on a list, I'm not sure if a lot of people are going to be aware of, but hopefully they're using it left and right in this pandemic. It's Amazon. And let me pull up the chart. Here's a weekly chart of Amazon. And what do you like about these guys?
I mean, I know it's not necessarily buyable here. I think it was, but what I do like about this is it's coming out of a big, 2-3 year base.
Mm-hmm.
And, an interesting thing with a lot of, this is just unbelievable institutional support. When you look at the weekly chart, all those tight closes around 1750, 1800, showing great institutional support. Longer term, I think if you hold this, stick with it. Use the 10-week as your guide. Shorter term, I wouldn't chase it here, but maybe wait for a pullback to the 20-day or in the next pullback as an opportunity to scale in. What I do like is that even though some money managers who I highly respect, for example, David Tepper, Stanley Druckenmiller, they gave cautious comments on the markets recently. They both specifically mentioned Amazon as one of the positions they love. Going back to what I said about, they were already a great business and they're benefiting even more, unfortunately, but they're benefiting even more from what's going on. So you have a lot of even value managers, Jeremy Grantham and Bill Miller. When value managers have been in this for a while are finding value in Amazon and growth managers, I think that's a very powerful story.
Yeah, and that's almost a perfect storm with like Apple's kind of like that a number of years ago, where you could find reasons to be, if you're a growth fund manager, to have Apple, and then now value funds were starting to buy it a little while back too. So Amazon's almost, you thought that they were already in the perfect place in the right place at the right time, but it's kind of even more right because obviously we're all so dependent on it. Thank God for an Amazon, first of all, because I don't know where I'd get anything these days.
I think what I forget the exact stat, but 18% of shopping is e-commerce, and now it's moved to 25 and just recently. So obviously Amazon is such a huge beneficiary. And again, I apologize if I forget the exact stats, but the point is e-commerce spending is going to obviously increase, and Amazon's a huge beneficiary of that.
Yeah, and I saw a stat like that. Probably a very similar one, but it first the couple of things came to mind. First, it was pretty amazing that it was still so low. I because pretty much everything I buy these days is through
Agree.
e-commerce,
Agree.
right? But that was just really eye-opening. And then the second was that acceleration over the last couple of months where you saw that really big jump. Now, the other question to ask is like, how many of those people are now going to start to turn to Amazon Prime members? And because once Amazon gets you in that Prime
Yeah.
membership, they have you for life right there.
Yeah, that's a huge point. And also, we can't forget about AWS is really the powerhouse, Amazon Web Services, as more people working from home, which is why internet security and software and all these names are, everyone's beefing up their networks and security and so forth, as more businesses are going to be working from home and shifting to that. And Amazon Web Services is also a huge, it's going to benefit from that as well.
Yeah. So the next stock that we have on the list is Nvidia, and that's ticker symbol NVDA. And this is another company that I'll go to the monthly chart first for this company, but this is one that in 2016 had this amazing run.
Yeah.
And it was the stock to own in 2016 and a bunch of 2017. Then it had like a 50% correction, like all great stocks will. They're going to take some time off. And now it's back into all-time highs. And it seems like it's really now starting to assume that leadership position in the semiconductor industry, at least for large cap. I know Inphi has been doing pretty well too,
Yeah.
but it's always kind of debate AMD, Nvidia. Right now, it looks like it's Nvidia's turn to carry that flag for the semiconductors.
Yeah, I mean, they're both great companies. I like to pick best of breed, in my opinion. It's one of the top 3 positions I hold for clients. Excuse me, we bought it, whatever, 280, something like that, and sticking with it. Of course, it's a little bit stretched here, similar with Amazon,
Right.
but longer term, maybe wait for it to come in. And I know they have earnings coming up, but longer term, I believe that this is so many verticals in gaming and AI and machine learning. I mean, they are basically dominating with driverless cars, as more and more cars are going to shift to the Tesla model, not just driverless cars, but having that monitor and that screen there that's powered by NVIDIA. I mean, NVIDIA is the true leader in a lot of the future as we are moving from CPU to GPU, meaning graphical, users. Graphical, everything is graphics these days. So you need that processing power, and NVIDIA is in so many verticals. They just purchased Mellanox. I think they bought them cheap compared to their peers. So that gives them a huge advantage in data centers, which continues to do well. So I love the story. I love it longer term. And obviously, again, like I said with Amazon, if you're in from an earlier level, I would stick with it. And if not, just maybe wait for a pullback as an opportunity to scale in.
Yeah, and like Joe, I do own both Amazon and Nvidia in my accounts. And Joe, yeah, this stock right now it is 30% from the couple that handle that pattern recognition picked up here.
Yeah.
They do have earnings tomorrow,
Yeah.
and so that's going to be it's going to be interesting to see. I know me personally, I'm going to hold pretty much all my shares into earnings.
Yeah, no, same here. Same here. If it pulls back, I mean, I'm not being complacent. I'm just saying when you have a good cushion, if you bought it properly, 270, 280, I even tweeted out right below 300, that Jesse Livermore rule, when they breaks round numbers, you get a quick
Yes.
10%. I
Yep.
mean, if you're up 20% on it, this is where everyone needs to know their own time frame. I like this longer term, so I'm sticking with it. But if you told me you could buy it as a run into the earnings and make 20%, you could also take some profits. But everyone can make their own decisions. But I just think that powerful move is similar with Amazon, a couple others, Netflix and so forth, coming out of these 2-3 year bases. They could just be getting started if this is, in fact, a new bull market.
Yeah, and well the first question, and a lot of people I'm sure ask you this, and they definitely ask us over here too. How do you handle earnings? How do you handle earnings?
The 2 biggest questions I get do you hold over earnings? And, with biotech and all this stuff, these questions are all centered around fear, where no one wants to lose money. I get it. You don't want it to gap down. You don't want a biotech to gap down. It's such a difficult question to answer. My whole thing is, is keep us positioned smaller if you're that worried about it. Meaning you don't have to have a monster position because you need to build confidence. If you do believe in some of these big winners and you want to take them for more than a 10 or 20% gain, by definition you have to hold it for a few quarters.
Right.
By definition. So that means you're going to hold over earnings. So you just have to realize there's a big difference between holding, a highly volatile stock over earning or maybe more conservative name. I think they're pricing in a 6 or 7% move. But let's say you price in a 10% move. Reduce your position size to the point where if it does drop 10%, it's not going to ruin your portfolio. And I think the way to handle that is to keep. I hold a lot of things over earnings. I just make sure to keep a position that, let's say it's pricing in a 20% move, and I have a 2% position. If it has that worst case scenario of dropping down 20%, 40 basis points is not going to ruin my portfolio.
Yeah, and that's generally what I assume. I assume a 20% gap down
Yeah.
on it, and then I'll adjust to see which ones where it won't kill me at
You
that
could
point.
also get it. You could also get a gap up. I mean, everyone's like, "Oh, I don't hold of earnings because they all blow up." Look at Twilio. Look at Fastly. These moved 50% off of earnings. So
Right.
this fear. Then we talked about this in the last podcast. This is where the mental toughness of you got to stop living in fear. I mean, I'm not saying to be reckless. I'm just saying, especially if you have a cushion and you like a longer term story and there's great longer term option activity in some of these names, I just say, reduce it to a sleep at night position. To your point, if it gaps down 20%, you can live, because guess what? It also might gap up and you might make some money.
It's true. And now another thing that you mentioned with all these larger cap tech stocks emerging out of these large bases, multi-year bases. One of the questions I can already hear people asking is, how much further can some of these stocks run? Now, Amazon's at 2,000 right now. How much further can Nvidia run, and all these kind of stocks run? What are your thoughts? This is almost another disconnect, that concept that we were talking about earlier.
I mean, one lesson I've learned in the markets is just when you think a stock or a market can't go higher, it usually does. And just when you think it can't go lower, it usually does. I think of some big winners. Home Depot and Walmart were big winners in the O'Neill books from the 80s and 90s.
Yep.
And they are still making new highs, because my answer to that is we are no longer an economy that's only based on the U.S. When you take examples of, the Walmarts or McDonald's or some of these big winners where they start with, Home Depot, a few stores, build it to more stores, expand to more, expand globally with a lot of these companies. We're just not, we're third world countries are no longer third world countries. We're in a global economy, and there is much, much room for these to grow.
So let's go to the third idea, and this is ticker symbol AYX, Alteryx.
Yeah.
And these guys are another company that helps manage big data. I think the bigger name that probably most people are familiar with is Splunk, but AYX has been doing quite well and kind of sneaking under the radar. What do you like about these guys?
Yeah, same thing. Big data, artificial intelligence, great subscription model that they have. There's some sharp funds behind this. I think it's coming out of this sort of big double bottom on the weekly. It's made a great move. And like we said, after big moves, they consolidate. They have some new products rolling out in June with data warehouses and also with big data and so forth. So I like there's longer term option activity. And also they guided lower in their most recent earnings. And trading at this time sales, I did have a position and I said, oh, shoot, this thing might gap down more than 10%. The fact that it barely gapped down and was gobbled up in 2 days, that tells me, we talk about this all the time. It's not the news. It's the market's reaction to the news that matters. You've seen companies blow out their earnings and you're like, why is it down? This one guided lower because of the COVID situation and so forth. And it was gobbled up, telling me institutions, especially some sharp ones that own this, really understand the longer term story behind this. Of course, it's rich in valuation, but PE has never been an issue for me because as if you study the biggest winners throughout history, they tend to trade at much higher valuations because you get what you pay for.
Yeah, and you mentioned with the earnings reactions, is this the most forgiving earnings season you've ever seen?
It's been forgiving, not just with earnings, but I've seen some gap downs on just regular news. I've also been stopped out of a few things that literally turn on a dime and are at new
Right.
highs. So that's more of a sign of a strong market when it's forgiving, because it can forgive your mistakes. It can forgive, you can get a little bit sloppy with your entries, not encouraging that, but just have to keep that in mind. When it's a good market, the market forgives some of your mistakes. When it's not, look out, because it doesn't matter what you do, you're going to get chopped up. So I agree, though. Some companies haven't had great earnings, but people just don't care, and they just go higher anyways. Because one huge factor that we're leaving out of all this is, of course, the Fed. The liquidity behind the Fed is also helping a lot of
Yes.
the situation. I'm not going to ignore that. I'm not going to argue it. I'm just going to say, hey, take advantage of it while it's here.
Now, Joe, you've spoken about a lot of concepts here. Now, a lot of people can learn about your stuff on Twitter, but you just added a new addition to your website, right?
Yeah, no, thank you. I started a new educational product because I truly believe, and I have the book here, How to Make Money in Stocks. I think this is one of the best books in investing. I'm not just saying that because I'm working, talking to someone from IBD, but the only problem with the book, I shouldn't say problem, one concern is that there is so much information. I think you can agree. You read it once, it's a lot to comprehend. So I started a new educational product where my purpose is to go through not only a lot of the concepts in the book. So when we talk about follow through days and all these setups and technicals and fundamentals, go through a lot of the concepts from the book, stuff I've learned on my own, stuff from Jesse Livermore, and not only teach that, but apply it as best as I can to the current market. And it's on my website, joefahmy.com. I've been very grateful, got some great feedback, and I think it really helps with the learning curve from 21 years of doing this to really help people learn a lot of the concepts.
No, it's good stuff there, and I highly recommend everyone go and check it out.
All right. No, thank you. Thank you. It's something I'm proud of, and I'm enjoying breaking down and analyzing the markets.
Excellent. So there are a few ideas that are worth considering and adding to your watch list. Thanks, Joe, for joining us today.
Thanks for having me, Risha. Always a pleasure.
Next week, we are going to have two of the leaders from O-Shares ETF Investments on the show. We are going to have Connor O'Brien, who is the CEO and president of O-Shares ETFs, and we are also going to have their chairman, Kevin O'Leary. Yes, that Kevin O'Leary, the Shark Tank Kevin O'Leary, is going to be coming on the show. He's also known as Mr. Wonderful. So we're going to talk about some of the larger internet trends that they're seeing, and they've developed a really great ETF. The ticker symbol is OGIG. That is capturing some of these trends, and it's doing quite well this year. So it should be a ton of fun. And so that's it for this week on Investing with IBD. I'm Marusha Paris, and thanks for listening.